So, tariffs and turmoil. That's what's going on, and that's going to be the topic of today's live stream. We're going to be joined today by Brian Stutland, longtime CNBC friend and colleague, today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Mic. As I just mentioned, today we're going to be joined by my good friend and longtime CNBC colleague, Brian Stutland. Brian Stutland is the CIO of Equity Armor Investments. He was also a CBOE floor-based options market maker and traded, among other things, options on the VIX. And so he seemed like the most appropriate person I could think of when we started dealing with a more volatile market. Brian, how are you? Good to see you.
And provide some insight.
All right. I'm just going to make sure with our producer, Jay, that our audio is... All right. Our audio is working. So, first things first, why don't you just... for anybody who happens to be watching that doesn't know you, I thought it might be appropriate for them to get a little bit of background about you, what your professional background is and so on. You were like me, a floor-based options market maker, and just give us a little bit of your options trading history.
Yeah, so I started trading back on the floor 98, 99 after I left college. I thought I wanted to be a doctor or engineer at some point, and scrapped that and became a market maker on the floor. Really kind of cut my teeth trading VIX options when they listed in 2006 on the CBOE. They became very popular contracts to be used for people to sort of hedge a portfolio, right? If you're going to own VIX, this is a way to buy VIX, buy volatility in the marketplace directly. And we saw tons of institutional traders come in, retail starting to trade it, and that contract just evolved more and more. And so we were sort of at the start of it, acting as market makers, providing liquidity for people in that particular product. And that's where I really cut our teeth. And then Mike, obviously we met on CNBC, options action, talking trades all the time, on ways for people to, as our producer like to call it, risk less to make more. But the floor trading was really where I got my experience and where we developed risk management tools now for both institutions and individual clients to use.
Yeah, I mean, I think it's important for everybody who's watching to know that one of the key things that I would just like to point out, we don't talk about it too often, those of us who sort of traded options professionally first, that, options trading for what I would call professionals, those are people who actually trade volatility, is a very different beast, if you will, than what we talk about every day when it comes to options overlays, option strategies to make directional bets, options structures to hedge an individual stock or a portfolio. But I feel that it is a really important background to have because you need to understand how options behave, what impacts their value over time as volatility changes, as the price of the underlying changes, as rates move around. All of those things are sensitivities that options have, and of course you have a really strong background in that. So when did you start? And actually, you mentioned that you had thought about becoming an engineer. You actually are an engineer, though, aren't you? I mean, didn't you get both an undergraduate degree and a graduate degree in engineering?
Yeah, that's true. I do have a undergraduate in chemical engineering and master's in biomedical engineering. And I thought I wanted to focus in on biotechnology research or go become a doctor, maybe even someday. But obviously, the mathematic principles of probability of there's actually even some principles within the chemical engineering world that get applied to option trading. And so just to use those mathematical skills and sort of learning this extra derivative product, which are options, right? A call contract and a put contract are the right to own something. You don't directly own it. And for that reason, they're kind of called a derivative kind of contract. And so those mathematics really applied and we're able to translate, from engineering to where I am today.
Yeah, I remember when I first started as an options trader, probably half of the people in my first trading class that came, that we all came in together were engineers. And we seem to attract a lot from Cornell the year that I got started for reasons I'm not exactly sure of, but yeah, engineering is obviously engineering, mathematics, obviously an important background. There are people that have a background in options trading, including yours truly, that were not engineers, but it's a pretty good starting point. So at what point did you break off from that and start Equity Armor, and what are you guys doing now? And then let's talk about that what you're doing a little bit, and how the folks that might be watching can start thinking about the use of options to improve their risk-adjusted performance.
Sure. Yeah. I mean, really, I started working for a firm. The name was called LETCO. It was a more proprietary firm, but it was a market-making firm. They had a very big presence in one of the pits, trading Cisco and Oracle options back at the internet bubble days. But when I left that firm, I started my own broker-dealer, started trading on the floor, like I mentioned, trading VIX options and taking positions in there. Really, as a market maker, it's a little different than a retail trader or even institutional traders. Those types of guys are trying to take actual positions in the market. A market maker is actually setting, a bid somewhere below where they theoretically think something is worth and selling above it, and trying to sort of make those nickels and dimes all day long, stay fairly neutral in their book as best as they can, and trade sort of the implied volatility of those options and how that translates to realized volatility. Now, that kind of gets to like where we are today. We launched our own investment advisory business, which we currently sub-advise to a couple mutual funds now as portfolio managers to that. We also have individual clients. We have other investment advisors that use our trading models as well. And we started recognizing trends in the volatility space in the options market. And we started building models to sort of mimic echo sentiment of long positions in the market with a hedge, right? And finding different ways to sort of give people almost a liquid alternative investment style strategy in the market, and using some of the techniques we use on the trading floor to apply as market takers now in the market, trading for other individuals and institutions.
LETCO, I don't know how I would have missed that. So LETCO, you guys had operations on the Amex too. I remember. Was Mike Riley one of your guys? I think he was across from me in the red room.
Yeah, he was actually. Yeah, so we had operations on the PCOS. We had him on the Amex, sort of all over. Although my team really focused on our own book of trading at the CBOE. We at that time LETCO wasn't as sophisticated. As like time passed in the options world, you saw all these traders and trading firms develop these, they're trading Microsoft options versus the S&P and an entire book of business. And it wasn't until LETCO got bought out by TD Bank, which is now TD Ameritrade. When they got bought out, that's when they started aggregating entire books together. But the Amex guys acted like their own trading, which seems kind of silly. One of us could be long an option. The other guy probably could have been short another strike somewhere else in the same security. But we all found ways to make our own money.
Yeah, so it's interesting. That was actually our business was trading dispersion, mostly technology sector stocks against the Qs, that sort of thing. We never really knew what our competitors, the prop traders at firms, across the way might be up to. And look, there were plenty of people who could trade options as a standalone market maker and kill it, right? But one of the things that we found was that it was certainly advantageous, and it was really about risk management and diversification to be able to do something like trade dispersion. And for those of you who don't know, we've brought it up on this channel before, but dispersion basically means the conventional dispersion trade is for an options trader to be long options on single stocks and then short options on a broader market proxy. That could be a sector-based ETF or index. It could be Q options and things like that. So let's just talk a little bit about what's going on in the market today, because we've seen a big uptick in volatility. It feels as if market participants are getting really whipsawed by all of this tariff talk. Are we going to have tariffs? Yes. They're going to be 10%. No, they're going to be 25%. But we're not going to do it today. We'll do it tomorrow. We'll do it April 1st. Not April 1st. I'm superstitious. It's going to be April 2nd. If you're an automaker, we're going to hold off for a month. But we're definitely going to do it. We're going to do it. We're going to do a tariff on VAT taxes. So all of this is really creating a lot of choppiness in the markets. What's your take on all of what's going on?
Yeah, I mean, there's no doubt that it is creating choppiness, and every time it seems like a news headline, all those that you mentioned are. It seems funny and hilarious, but it's so true. Where it's at, and it's causing the market to move pretty extreme. I mean, the VIX, which is sort of a measure of, well, first of all, the VIX is basically measuring premium options on the S&P 500. But furthermore, people sort of use it as an indication as how volatile do traders expect the market to be for the next 30 days. And when the VIX gets around 20, that's a little bit more on the elevated side relative to where things have been over the last, let's call it, decade or 15 years, right? And so this echo sentiment of more volatility, it meets what all the news headlines were saying. We're seeing rapid news headlines come out that move the market, and option traders want to own options in this situation, right? Like, you can buy something at a premium cost that's not going to cost you any more than the premium itself, and that helps you sort of risk a little bit less, so to speak. So they're willing to pay more for that premium right now. Today was kind of interesting, though, Mike. We did see the market get back down to the lows, but the VIX didn't make a new high. So it seemed like the fear subsided a little bit today.
So on my screen, we can actually pull this up, perhaps. I have here a list of what are called the Trump Tariff losers. I have here a whole bunch of stocks, individual single stocks, that are theoretically going to be more impacted by tariffs, and for different reasons, right? So one of the things you're going to see on this list is Best Buy, for example. And of course, a lot of the things that Best Buy sells are imported goods. Elf Beauty, which is a down market cosmetics company, they are dealing with more imported goods. So a lot of these companies that are importing a lot of the things that they sell are theoretically going to be more impacted. Have you seen much of that going on? And you have, a lot of your clients have single stock positions, right? So are you trying to bifurcate the stocks that you think are going to be impacted or not? Are you kind of thinking about it like the old dispersion traders did, which is, if we generally have them diversified and we try to mitigate those exposures, we can sort of buy some broad market insurance? Or are you trying to be more strategic and tailored with the things you're doing? And what are the things you're doing?
Well, we found, yeah, we're right. I mean, we do have a portfolio of stocks, right? Two mutual funds we manage. One has to own the NASDAQ 100, but the other one is self-picking on our side, right? We're going to own 40 or 50 names. And, to speak to how we diversify, right now, our feeling is I want to have a very high, speaking of dispersion, but I want to have a very high correlation to the S&P 500, because you mentioned some of these names that can be impacted by the tariffs one way or the other. I want to create the diversification to feel more of like a general market index right now, and be sort of tied to that. There'll be plenty of upside to an S&P 500 position, but I want to mitigate some of the single stock risks, especially to the tariff side. And really, our portfolio has skewed a little bit in one area, which is the AI world of technology, which has struggled a little bit this year to date. Basically, once DeepSeek came out and talked up their game, or whatever that is, that they've built on a cost of nothing, that's had a somewhat of a negative impact on a lot of the other AI names, at least made people wake up to all the spending that they're doing. But in the other area, we've been pretty much in the large cap value areas of the market. From Berkshire Hathaway to actually Apple right now is in the large cap index, actually, because the valuation has come down so far. Other names that in the financials that sort of fall in that large cap value, that's where we want to be. Those two combinations have given us the highest correlation to the S&P 500 and allowed us to sort of participate in the market's movement in that sense, but not get too caught offside by this tariff situation.
So let's talk about that data. I just sort of blurted out the data center part of it because, of course, the hyperscalers are certainly part of the AI trade. I don't know if that's one of the things you're doing, if you have much exposure to energy. I mean, as you're thinking about the AI trade, where are you weighted most heavily? What do you think is the biggest potential winner there? I mean, I'm going to assume NVIDIA is somehow in that mix. What else you got? And what are your thoughts on Nvidia here? It's obviously pulled back quite significantly from the highs that we saw.
Yeah, Nvidia is in our portfolio for clients. Yeah, it's pulled back. It showed a pretty interesting reversal though yesterday, where it traded lower right around the 110 area and swiftly moved back up into the mid 1 teens. And so that was kind of an interesting reversal. It almost felt a little bit of a capitulation bottom on Nvidia. I thought the earnings that came out were pretty good, and the market got hit very hard. And I think there were some concerns about their involvement with some other dealings and selling their chips either through Singapore or other channels where China was able to then acquire those. I think there's a part of the marketplace, there's chatter out there that there is some level of dealings that indirectly where they are going around sort of their ordeal and being barred from selling directly to China, but doing it in other ways. People are concerned that somewhere down the line, somebody's going to come down on them in that area. And so we saw the stock sort of sell off after its earnings for the few days after that. But I think the other day was a little bit of a capitulation, like I said. And, that's a name that we own along with others as well.
Yeah, I mean, it's, I'm taking a look here on my screen. I actually have SPY versus NVIDIA, and, we'll notice that they track fairly closely together. One thing I would have observers consider is that, when you're looking at a name like NVIDIA, because the S&P is a cap-weighted index, and so much of the trade that Brian is talking about are these larger cap stocks that you might not see a huge distinction between what they're doing and the market is doing for that reason, right? Because a lot of it's all basically the same trade. Technology is like 40%, I think, on a cap-weighted basis of what's going on in the market. How are you hedging the volatility, I guess, is the first thing I would say. I mean, the mutual fund, are you trading options in the mutual fund, or is that equity long only, or what's the structure of the mutual fund?
Yeah, so in our fund, we are long stocks. Majority of the portfolio is like that. We try and sit around 90% owned of single stock equities. But at the same time, we want to provide a hedge, right? So that other 10% sleeve is looking to hedge out the portfolio. Now, we do that through a combination of owning VIX futures, or we own sort of what I call straddles, right? That's being long a call and long a put at the same time, or some synthetic version of that, right? So we want to be option owners. I think, a lot of strategies that are out there that are option trading strategies really predicate on selling premium, sort of out of the money premium, collecting income, and saying that they're sort of these risk defined type strategies. Well, we don't try and be risk defined, so to speak. What we try and do is participate when the market moves continue to participate when the market moves to the upside. Like so many other strategies sort of get called away. We're actually long options, so we would be long a call in that situation and get some extra leverage to the upside. At the same time, to the downside, that long put or the VIX futures position that we own would help protect the portfolio. So since we become managers, thankfully, we haven't had month over month, we haven't had more than a 7% drawdown month to month since we started. So we really want to create that level of protection to the downside by owning volatility here. So we think a lot of times that there's a lot of talk about selling options, collect premium. I think it's actually almost normalized. Like back in the day, Mike, when we were trading on our trading floors, it was like, okay, sell option premium because they're always overpriced. That's not always the case, I don't think, anymore. I think we're getting more volatility in this marketplace than people expect at times, at least intraday, to take advantage of those moves. So if you can tactically be an option buyer, it has paid off in moments of time over the last, call it, 5-6 years.
So I guess my follow-up question to this then is, number one, how do you offset some of the theta that being long options, long convexity can create? One of the things I have observed is that, for many of the years that we made markets and options, the prevailing level of volatility was higher than what we've seen in many recent years. So, for example, if, the kind of volatility we saw in the late teens, the late 20-teens, like 2017, up until we really saw the market kind of roll over in the fourth quarter of 2018, those were very low volatilities. I don't know that in the late 90s and certainly not in the early aughts that we ever saw consistent single-digit realized and implied volatility in the broad market indices. In fact, before that, I think that if not all of the VIX history actually existed, but they went back and they synthetically recreated a VIX history. So if you look at a history of the VIX index, they took a look at historical SPX implied volatilities and then constructed what the spot VIX index would have looked like. If you went back in time, I think that historical number was something like 19 or something, which is a very high number if we think about it now. But that wouldn't have seemed that wild back in those days. So what I've observed happens is that when volatility gets very low, realized volatility gets very low, options premiums will fall, but then they kind of reach a floor. There's a point at which somebody says, you know what, no mas, I'll sell 9 vol, but I'll not sell 8 vol. and consequently, I'm not sure where that arbitrary, and what you see sometimes is that the spread between realized and implied, and it seems counterintuitive,
Yeah.
but you sometimes see that the volatility risk premium, the relationship between index options prices and realized vol on that index, can spread out a little bit when vol gets very, very low. And I imagine that creates some form of drag, right? If you're trying to hedge your volatility, how do you manage that?
Yeah, there is that level of drag. Obviously, right now we're in, I think, a somewhat different time. You mentioned that, let's just look back to the 20 teens, let's call it. Obviously, the government stepped in after 2008, and there was tons of, let's call it, money printing, right, or liquidity providing into the system. And whenever we see that, even after COVID, March 2020, and the federal government, and we saw stimulus packages come in, that level of money printing creates a level of liquidity that does sort of dry up volatility, right? It sort of lowers volatility. People kind of can expect what prices should be worth. And so you see this extreme decline in volatility. I think we've left that kind of area after 2022, and we've had to raise interest rates again, and now the 10-year back in the 4 handle range. There is this level of volatility that's creeped back in the market. But having said that, there are periods of decay, Mike, like you're talking about, where volatility starts dropping, but option prices sort of get overpriced to some degree. And what we like to do is a continual rebalance. I think whether you're owning a straddle or owning a call, I don't think option prices were ever meant to just buy and hold all the way to expiration. There's a level of trading component that goes on. Now, whether that means, let's say you bought a put and stocks go down, that's time to sort of harvest the crop of the volatility that you own, that put option contract, maybe sell a little bit of that and buy stocks lower. And what we try and do is do this continual rebalance between our, let's call it 90% stock weighting and that 10% volatility to help mitigate some of that risk. That's sort of like the retail version of gamma trading of an option is to rebalance your position. If I'm going to trade some options, if I'm going to get long options in particular, I'm probably not going to just buy it and then close my eyes and hope those things finish in the money past the break-even point. I'm going to continually manage it and roll it and move it to different areas as the market moves.
So let's try to walk the viewers through kind of a specific example. And I realize that different volatility environments will require you to make some adjustments. You might find some spots on the term structure that are more appealing, some that are slightly less, some degree of either moneyness, or I don't know how you normally identify your strikes, if it's moneyness, if it's sigma, if it's delta. But let's just kind of walk through what the average person might think about as they say, okay, well, how should I hedge this? I'll give you an example. So earlier this week, I was on Fast Money, and they said, how do we hedge? And I made the following observation, because Carter Worth was saying, I think this is a relatively dangerous situation. The average move, so once the S&P has fallen more than 5%, I think he identified that the median drop, peak to trough in those kinds of pullbacks, was something like 6.75%, and the mean was some slightly lower number, like 11% or so. And so the idea was, and then I looked back to the fourth quarter of 2018 and said, are the Trump tariffs the same thing as what the risk was then? Not exactly, but you had these exogenous factors that were impacting. So let's just say, for the sake of argument, that the market could pull back another 7, 8%. What I said was implied volatility is higher. The timing and duration of these is usually just a few months, maybe, in these types of pullbacks. You might have a, sort of a swoon period and then come back. So I said you could go out to May and maybe do something like a put spread collar at zero cost, sell a call up near where the S&P was at its highs, figuring there would be some upside resistance. What would you suggest? Is that idea that I proposed there completely out to lunch? And is there something that you would say as a counterpoint or as a different type of a suggestion that people could use?
Yeah, one thing, the zero cost collar is a pretty. I like that strategy in the sense that you're being kind of neutral on implied volatility, so to speak, right? I'm not buying an option when implied volatilities are very high, which can be somewhat dangerous because then you buy the option and it just doesn't ever pay off for you because the break even level of the premium you're paying, plus the strike price put to the downside, positive to the upside on a call, you may not get through there, right? And so the zero cost collar is an effective way when volatility is very high, especially if you have a level in the market where you're like, hey, look, I don't think the S&P, for example, is getting back above to its new all-time high around 6,200. I can sell that call comfortably and decrease some of the premium outlay by buying a put. I think another way to look at it too, though, see, that gives up the upside, right? If you're wrong about the upside and it never gets back to there, great. But if it does, you've kind of missed out, and then you're kicking yourself. What do I do with myself after we've gone through, let's say, 6,200 on the S&P? So another way I like to look at it is the put spread side, right? Is owning a put spread to protect the downside. Or if I'm going to just outright buy the put, I'm going to trade around that. So when I see the market move lower, at some point I do have to look to sell out some of the volatility that I own. And so that might be then selling a put further down on the term structure, or finding other options to sell sort of around that. But I personally, I don't love giving up the upside all the time, although the zero cost collar makes a lot of sense when the VIX is in the 20s. When the VIX is a little bit lower, if somebody's looking for a strategy to sort of hedge and they've seen maybe the VIX come off and they're worried about, hey, tariffs down the road and we get another downturn in this market, then I might be okay just owning a put, but I'm going to trade around it. I'm going to sell another further downside put when the market does move down, to sort of mitigate that total premium risk.
Yeah, it's interesting that you should mention, because it was partially the fact that the VIX was trading around 22.5 or so when I framed up that trade, because generally, and people who watch this live stream know, that it's more often my preference to be long vol. I often will trade SPX strangles on the long side and use that as basically as a reservoir of dry powder, against which I can look for opportunities to sell vol elsewhere, and then try to keep it, that as a package, I usually try to maintain relatively delta neutral. So I've got the SPX basket that I try to keep relatively delta neutral, and then everything else I'm going, and that's the hedge, right? That's my long vol sort of component. And if all hell breaks loose, particularly if you get something where you get a jump, like price jumps, so discontinuous pricing, options traders will know that, the thing that you like best is for prices to move if you're long options and you're long vol, you want to see a big gap type of move, because what that will do is it actually prevents you from delta hedging as something happens. Like you get a windfall profit instead of, it bleeds a little bit lower and you keep hedging your deltas, and then it goes a little higher and you hedge out a little of your deltas. If you get a situation where you're long SPX vol and the market moves 3% over the weekend, you wake up on Monday pretty happy about that move.
Yeah,
usually. So I guess, the next thing, and I think we have, I don't know if we have some questions in here. Let's see. Oh yeah, we do have. So let's see if we can take a couple questions, and I will put them up on the screen here. So PC says, all right, 1 month implied correlation. The index goes along with VIX. If it spikes higher, options market is pricing a macro sell-off. Trades for a small investor when core implied is above 50. So this is kind of interesting. So let me see here. So this is interesting because, and of course you guys have to bear with me because I'm always looking at this on a relatively small print here. So let me see if I have an implied correlation number. First of all, what is my? Let's go like this. So a quick, just a quick, and actually, you know what, Brian, while I'm looking for the implied correlation number, why don't you explain to anybody who might be interested what higher or lower implied, well, first of all, what implied correlation is. Yeah. So that's that's kind of the opposite way of thinking about the dispersion, or it's this, long correlation is the opposite of long dispersion, but it's the same trade. So why don't you explain to people what implied correlation is?
Sure.
And I will see if I can find something that we can kind of show.
Yeah, and I think
timing.
I think why the person's probably asking it too, to get to the answer of what implied correlation is as things, think of it as things sort of trade in correlation to each other, right? Like if I'm long Microsoft, which is in technology, but I'm also owning McDonald's, let's say, which is a consumer staple discretionary kind of stock, how much of it are they moving together with each other? And the more parts, the more components that are moving in the same direction and the same amount of volatility, the higher correlation is. And the higher correlation is what option traders have typically known, is that there becomes more volatility in the marketplace, because now, instead of, think about it, Microsoft is up and McDonald's is down, the index as a whole becomes less volatile because one part is pulling one way while the other is pulling in a different direction. When they're both moving together, you get bigger extreme moves in the marketplace. And so option traders love looking at the correlation index to see how are things moving together, because you can't drop a bowling ball in one end of the pool and not expect the waves and ripple to reach the other side. How big of waves they are is depending on how correlated things are, and how big that bowling ball is. And so traders want to watch that, because there is this ripple effect that occurs throughout the entire pool.
Yeah. So just to sort of elaborate a little bit on what Brian's talking about, because we've brought this subject up more than once. There's a couple things that professional traders will often say, is that, number one, under times of extreme market duress, the correlation tends to 1 in risk assets. That is to say that when everybody gets into risk-off mode, they become, pretty much, they're not judging what they sell. They just sell everything. And so correlation goes up in that circumstance. There is, for what it's worth, kind of a neat and tidy back of the napkin way to think about what the volatility of a portfolio will be as a function of correlation. And that work was, I think it was JP Morgan. Was it JP Morgan? They did a paper that came out around, if my memory serves, around 2006. And in that paper, the sort of closed form solution for identifying what the volatility of an index would be is, it is the sum product of the volatility of the constituent stocks of a basket of securities times the square root of correlation. So that was essentially the mathematical back of the napkin thing. Now, that doesn't really work when correlations get down to close to 0, but it was kind of or implied volatility, I should say, for the index gets close to 0. But in general, it's a way to think about it, that the volatility of a basket of securities is going to be functionally related to basically the square root of correlation between all of the constituents on a weighted basis. What I have up on the chart right now is the 1-month correlation index, and as we can see, unsurprisingly, it has spiked materially in recent days with all of this tariff talk. So I guess the question here, what is the trade for the small investor when implied correlation shoots up. Now, we're nowhere. Which one was he looking at? 50? Oh, no. So he's looking at an implied correlation. I don't know which correlation. 1 month correlation right now, we're at 27. So 50 that's a really high number.
Yeah.
What do you think is the trade for the small investor when this is above 50? Let's see, when was it last above 50? I mean, the VIX would have to be at some massive number. Here we were. So we're, oh yeah, of course, August 5th of last year. That was a wild day.
Yeah.
Yeah.
Yeah, that was. I think the VIX futures were up maybe like 60% or something in a very short, maybe a couple of days there in August of last year.
Yeah, let me throw the VIX index in here as well so we can kind of see what that looks like. And let's get rid of all of these moving averages. We don't need those. So what do you think? What does one do if you see implied correlation? And look, for those of you who are not following implied correlation, you could also think of this as a big VIX spike, right?
Yeah.
So these are very likely to be happening in tandem with one another.
Yeah, I think sometimes correlations can sometimes lead the market where they come off a little bit before the VIX comes off. And when I do see that, I become a little bit more bullish because I feel like the institutional option traders out there are predicting they're trying to find a bottom to the market. They're selling puts on the downside in the market to try and find this bottoming process. And so you start to see VIX make lower highs or implied correlations start to make lower highs, and I think that's a very bullish indication. But if I was a trader and I said, oh, I see these implied correlations very high up in the 20s, 30s, 40s, or the VIX in the upper 20s, that might be an area where I start to look to put new money to work. But I do that usually owning a call spread, which is very similar to the zero cost collar, right? The zero cost collar, you're already long the stock and you're buying a put and selling a call as protection against that. As someone looking to put new cash to work, I might buy a call spread that sort of limits the premium. I don't get too long of volatility because I'm buying one call and selling an upside call, hoping that we can race back up to the short call strike and capture that. I feel like that's a good way to put money to work. If I'm worried about more downside, sometimes I actually look VXX, which not a lot of that's not something to buy and hold for the long term by any means, but this tracks VIX futures. When those VIX futures get at a big enough discount to where VIX is at, so in other words, I like to have a VIX future contract, the price of that up on my screen, especially the front month. When that gets to a big discount to where VIX is at, there's enough sort of backwardation there where I can maybe even own a VIX futures contract as a hedge, small amount, 5% or something of the portfolio, as a hedge against a long position I might be initiating as well. So
oh yeah, so that's a really interesting point. So I guess my question is for the retail investor who's playing along at home. And by the way, I want to make one quick point. During the credit crisis, one of the things I was looking at implied correlation, and I remember when implied correlation in the S at one point intraday got to like 1.3. It was just completely out of whack. And make no mistake, if you're a retail investor and you're saying to yourself, oh my gosh, well, of course, correlation can only be as high as 1 functionally, right? Just know that these kinds of mispricings, you will see them on your screens, and don't think that necessarily means that professional traders are somehow able to take advantage of it. If you're Susquehanna or if you're Citadel or one of these players and people just happen to be let's say selling single stock vol and buying index vol, and you're just getting lifted and hit on the screens, that's great. But I'll tell you, I tried to put a trade on, nothing doing. You couldn't nobody would make a market for you on the wire. So, professional traders, we'll see these kinds of anomalies take place sometimes. That doesn't mean that, we get to, all of a sudden we have a license to print money. Those arbitrages are, number one, they're fleeting, even on the screens. So when you're sitting at home thinking, oh, I should be getting in on this and we're totally being taken advantage of, maybe some market makers are picking up a lot of money when that happens, but there's no buy-side trader who's going to be able to lock that kind of a trade in. So I'll just put that out there.
Yeah.
Not in my experience anyway. We see it. We wish we could, but it doesn't happen. But you mentioned that you look at the front month VIX future. So when you're looking at your screens, just tell me what you look at. You're staring at your screens. What are the key things that you're keeping an eye on? Spot VIX is on your screen, and then maybe the first 3-4 VIX futures in the term structure, something like that.
Yeah, I'll have the front four VIX futures up there as well. The VIX itself, obviously the S&P. I'm watching a lot on how much of a percent move is the S&P moving down to the ratio of percent move up in the VIX, right? So a 1% down move in the market, I may see VIX pop 5%. I start to watch that correlation as that ratio starts to change and the market moves. So I might see the market comes back, and then on the next 1% down move in the market, the VIX maybe only goes up 3%, right? So now the ratio has changed from 5-1 to 3-1. To me, it says, okay, some of the institutional buyers of volatility have subsided to some degree, or at least felt like the level of volatility is starting to normalize or mean revert a little bit. So I'm constantly watching that. And then, we mentioned here the discount of VIX to VIX futures. I think that provides some key levels where there's some opportunities to quickly own volatility, own VIX futures when they're at a discount like that in backwardation, not get hit too hard when the market rallies, because there's that level where the VIX will come off that, and both products, the VIX futures obviously settle into where the VIX index is trading at the expiration time frame. So there's some opportunity there to own volatility, because sometimes the market rolls over. Sometimes, even though VIX futures are trading at a discount, they get it wrong. Like you kind of were, mentioning here, Mike, institutional traders see these things out of whack. It doesn't mean they're in there making money and taking advantage of it all the time or know what's going on exactly. I have found when those big discounts happen, there's a chance for the market to roll over and there be a volatility pop to follow.
May I ask you a quick question, because you were talking about the percentage of VIX change. So when we used to track S&P versus VIX, the front month futures, for example, we would usually think percent to percent, meaning, and we thought of the VIX as a percent. So if the S&P fell, call it 50 basis points or 100 basis points, we were looking for VIX to go up by 50 basis points or 100 basis points. Yep. But the relationship you just described made it sound to me like you're actually looking at the change in VIX level over the level of VIX. So, for example, S&P drops 1%, VIX is at 18, goes to 19, right? So that's a more than 5% increase in the VIX. Is that how you're thinking about it?
Yeah.
And then you're measuring the pace of that percentage change. So now S&P moves 1%. Okay, that's really important, because for those of you who watch, I often think about it as percent for percent. In a normal market condition, the S&P falls off by, call it 1%, and the VIX goes up one handle, one unit. But that, the VIX being a percentage itself, that's the way I think about it. But that's really, so that's a very helpful thing. So I hope everybody makes a note of that if you look at the absolute change in VIX over the level of VIX as a rate of change and compare that to the S&P. I've never actually made that statement or observation before. So I thought that was very interesting.
What we find is when that rate of change of the VIX starts slowing down relative to the change in the S&P, we do see that is an area that the market is trying to find a bottom. Sometimes it gets it wrong and it rolls over, like I said, and that's why I'd consider using VIX futures in that sort of situation if they're at a big enough discount to sort of help protect in case it does roll over. But when I see that rate of change slow down, I feel more comfortable about putting new money to work or rebalancing my position or selling a put against a long put that I've owned, and feeling more comfortable. We saw that a bunch of times in 2022 when the market was down significantly over very short periods of time. We saw that rate of change slow down, and sure enough, you might have had the market fall another couple percent, but it really kind of found a bottom before it re-rallied back up again.
Yeah, so that's helpful. I'm gonna start doing that. I mean, I think I actually didn't even include the percentage change in VIX in my on my monitors because it always annoyed me. It always annoyed me when CNBC would say it. They would say, "Oh, the VIX is up 30%." I'm like, it's 1% of 1%. So it's always driving me a little bit nuts. But the way you use it, that's an interesting observation. I have not done that.
Yeah.
So we have a question here. MicroStrategy, it's stock specific, long put calendars expiring over the next several months. MicroStrategy's implied volatility has been cut in half. Should I jump ship or try to thread the needle by rolling to keep the price between my long and short strikes? So he's long put calendars, he or she, sorry, I'm not sure which. Long put calendars, but it sounds like you're trying to, I'm curious if you could follow up and just ask this. So my question is, for the person who's doing these put calendars, are you doing them delta neutral such that, so for example, you're long a longer dated put 20 delta, 30 delta, and short a near dated one, 20, 30 delta, which would create a diagonal. So I'm just going to wait for that person to hopefully give us a follow-up. But I'm going to put up the MicroStrategy term structure, which you may or may not be able to see in the return. Brian, hopefully you will be able to. So this is the MicroStrategy term structure. I only am looking out until July here. I can expand this.
MicroStrategy is an interesting story in general itself, and
isn't it?
How they're handling Bitcoin. It's almost like I've had trouble figuring out exactly what they're doing, other than the fact that the stock price is too high relative to the amount of Bitcoin they own, and they're able to sell.
So, let's talk about this a little bit. This is something I've been fascinated by, and Michael Saylor is making a volatility trade. So Michael Saylor is short vol, and the way he's doing this. So for everybody who's new to this, and I apologize to those who are already very familiar, but basically what's going on here is in MicroStrategy. They love Bitcoin. They are a long Bitcoin play. They are borrowing money to buy Bitcoin, but they are not paying interest on that per se. What they are doing is they are issuing low coupon or zero coupon convertible bonds. And because the implied volatility is astronomically high, they can sell relatively short dated paper, 3, 4, 5, out to call it 7 years, with very high implied volatility, and volatility arbitrageurs. So Brian knows, and I know people that came from our background that do convert arb. So what a convertible bond is it's a debt instrument that allows the holder to convert into the underlying equity. That conversion price is similar to the strike price of a call option, because that's what's embedded in the bond. So you say, I want to borrow $1 billion, but I won't pay you any interest. Instead, I will give you a call option on my own stock. The volatility of Bitcoin and the volatility of MicroStrategy is so high that the conversion prices for these bonds are typically 50% higher than the prevailing price of the stock. So what does this mean? It means that if I sell $1 billion worth of bonds, I can buy $1 billion worth of Bitcoin. And the value accrues to the bondholder in terms of exposure to Bitcoin once it has risen effectively 50%, right? So if the value of my stock goes up by 50%, then the holder of the bond is now, we'll call it in the money, right? So Michael Saylor's selling vol. The buyers of the convertible debt are getting long vol. Some of them are probably trading vol. Others could be fixed income investors who just want to have access to a long Bitcoin exposure as a hedge. I actually did some math on this, and I found that a 1% allocation to MicroStrategy bonds in 2024 would have added something like 200 basis points to the average high-yield investor's portfolio. It was absolutely ridiculous. And it made sense because it's kind of a counter-inflation or inflation hedge kind of a trade. So that's what's going on with MicroStrategy. essentially Michael Saylor is getting long call spreads with this borrowed money, and these other folks that are buying the convertible debt are senior in the cap structure, which is an advantage, and they have that kind of long vol thing. The downside, of course, is, and this is one of 2 points I would make about MicroStrategy. The first is, as you rightly pointed out, the book value of the 500,000 Bitcoin that they hold is less than the market cap of the company. Now, that can be okay. It can be okay because they have a mechanism, an accretive mechanism, where the holders of shares of MicroStrategy benefit if Bitcoin rises. And the reason is because they can sell $1 billion worth of bonds, buy $1 billion worth of Bitcoin, and then the shareholders get the first 50% of the upside, right? And that 50% of the upside is actually what the shareholders own, irrespective of what actually happens to the value of the underlying stock. So it is possible for Bitcoin to rise and for the MicroStrategy stock to actually converge to its book value. And then basically the shareholders get it all, and the bondholders are not necessarily getting a benefit. They don't get the benefit unless the stock price rises. Presumably it's very closely correlated to what happens to Bitcoin, but it doesn't have to be. So that's the nuance that happens there, and it's one of the reasons why if it trades at a slight premium to Bitcoin, I don't mind terribly, but I prefer for people who are interested in being long Bitcoin and they don't want to buy Bitcoin itself. They don't want to have, don't want to have a Coinbase account, or they just want to trade it like a stock. I would probably recommend buy IBIT instead, yeah. because you need to sort of understand the underlying derivative positions that are going on. So if you're buying calls in MicroStrategy is itself a derivative trader issuing these converts, and there's a lot of extra noise going on there. But it is kind of a creative play. Steve Garcia says, this is right up your alley. A week ago, I bought SPX. Oh, and you know what? I'm not sure if I completely answered that question. Okay. He followed up. So we got the follow-up questions on the diagonals, various differences between long and short strikes. Original short positions yielded a third or more of the cost of the long puts. Okay. But implied volatility drop has reduced the value of the long puts to make my original plan unworkable. They were originally calendars, but have been rolled into diagonals. Okay, so he had straight put calendars on, and then the change in implied volatility, and now he's in diagonals. So example, he bought the SEP 380s, the SEP 380 puts, and he sold the Jan 380s. So he paid $148 for the SEPs, and he sold the Jans for $54. Well, the Jans have obviously expired, and then you rolled those, presumably. Okay. So if you can see on the screen here, Brian, this is the term structure for MicroStrategy right now. This is kind of a helpful thing. So as a volatility trader, what's the risk to the long calendar trade? Where does that go sideways?
Well, the long calendar trade, it probably goes sideways if you blow through your short strike. Well, your calendar strike, let's say it's a put one and it blows through to the downside. You obviously get put to the stop. You do own a further dated put option against that, but it's like now you're long a call. Synthetically is what happens is you get long stock, long a put. That equals to being long a call. So you have some delta risk where you give back that money, that money you made buying that put calendar to the downside, which initially has a negative delta, starts to go sideways against you because you synthetically get long a call, and then you give back what you made. So I can see why maybe this guy was rolling that short strike down, but now when he rolls it down, that short strike premium is not as big to sort of offset the longer dated option that he had, and maybe it hasn't been as effective. But if the market continues down lower, there's opportunity to continue to make money. So I mean, it's probably a good risk management tool he's been doing so far. But if the trade isn't there, then maybe it's not there anymore.
Yeah. So I would my quick point is that the long, because I've talked about long calendar trades like strangle swaps and things like that. When I feel like near dated vol is too high, that's when I like to get a trade like that on.
Yeah.
Going into catalyst and anticipating a vol crush, that kind of thing. The issue that you have here is that if you're short near dated vol and near dated vol explodes, realized volatility, your gamma's probably beating you up pretty badly.
Yeah.
And that's, I think, what happened here. It was the 380 strike, stocks at 300. So it obviously, it fell 25%, blew right through that strike. So I will say that my guess is that things are going to stabilize for Bitcoin. And as they stabilize for Bitcoin, so too will things in MicroStrategy stabilize a little bit. What's happening, I think, in Bitcoin and MicroStrategy is a risk off. Yeah, everything was risk off. So everybody's just puking it. I think there was a news article out earlier this week that BlackRock saw one of the biggest outflows ever out of the IBIT ETF. And so there are hodlers, and there are people that are day trading, and day traders get as nervous as a long-tailed cat in a room full of rocking chairs when things start going the way they have been, and that'll be a bit painful. But yeah, so I think the idea is that if you're going to be in a short premium strategy and you like that strategy in general, you have to take the bad with the good. And the bad thing is, if you're short vol and vol spikes, you're going to get stung. But if in the general case you found that strategy works, I think you can actually stick with it. That would be my 2 cents, is that if you flip strategy so that you're short vol until it spikes and then you get long, that's not the recipe. Manage your risk within each bucket. If it's a short vol strategy, people can make money being short vol, they can make money being long vol. They usually are not going to make money though if you're just getting stopped out on your strategies each way. So what you'll see is that a short put strategy, which is kind of what this is too, they grind higher and then they have setbacks, and then they grind higher and then they have setbacks. And so it's just a different kind of a risk-reward relationship. I will say this, and this is, I think, one of the things that Brian is saying too, which is that in general, you want to be long deltas over the course of time. It's just really, I never knew how Jim Chano stayed in business as long as he did. If in a money printing world. Okay, so let's see this SPX strategy that got brought up. This one's for you for sure. Okay. Steve Garcia, a week ago I bought an SPX July 59,5600 put spread for insurance on my portfolio. Paid 66 for it.
Okay.
Did I go too far out in time? What are your thoughts?
Oof. Yeah, when I first heard you say the date, I was a little worried that it was a little too far out in time. I found that, let's call it 3 to 6 month put options on the downside very rarely end up paying off where the market gets below that long put strike and stays down below there over the course of the time. The volatility event that's going to happen usually happens within the 3 month window. So I kind of like to stay a little bit shorter dated in that sense. Now, if you're a long-term, let's say, buy and hold the market on the S&P, and you're like, I want to spend 1% of the value of my portfolio, which $66 with the stock S&P close to 6,000. So, maybe it's a little bit more than 1%. And I just want to sleep easy at night so that I know I'm protected between those two ranges. And then I'm okay getting long again. Like, these are defined risk kind of strategies that trade often in what's called structured notes. I'm okay with that. I mean, I think it lets you sleep a little easier at night. I don't know that this necessarily pays off. Like, you got, speaking of thread the needle, you have to thread the needle from now until that June or July expiration. It's got to be, pay off for you down there. So I'd rather go shorter dated, especially in this kind of market environment. I think there's enough volatility to kind of trade around that and rebalance, like I talked about. So, but yeah, I mean, I would say this strategy was a little bit better when VIX was at, let's call it 15 or 16, and those back month premiums are a little bit cheaper. it makes, as a casino bettor, the odds are a little bit more in your favor that you're going to get that premium to pay off for you.
Yeah, I think that that makes sense. I would just throw this into the mix, which is that generally speaking, I don't trade long dated spreads, like put spreads, for example, as a hedge. I'd rather either just own that put.
Yeah.
And the reason is this, and that is that if you can imagine, let's just say for the sake of argument, that the S&P fell to your short put strike tomorrow. What's going to happen to that put spread? It's a 59, 56, it's a $300 spread. You paid $66 for it. That call spread is going to be easily worth 30, 40% of its value. And so what does that tell us? That means the put spread can't be worth more than 60, at best 70% of its value.
Yeah.
So 60% of a $300 put spread is $180. So I paid 66 and it went to 180. That's a win. But it's not the same win that you would get if you own the exact same put spread near dated. So if it's disaster protection that you want, then near dated is going to give you more bang for your buck. First of all, you're going to pay less for it.
Yeah.
And secondly, it's going to go up more in value. So,
and I think to your point too is long dated selling that further downside put, that 5,600 put too, right? I would just rather buy the 5,900 put or maybe 5,800 put outright, not do a put spread, because that turns too much into a binary kind of trade that's got to work as you get closer to expiration.
And you said leg into it, right?
Yeah. I mean, maybe leg into it, right? Like vol is down, back month vol is cheap. You buy the 58 or 5,900 put, and then you do get this volatility event. Now you've got some bullets in your pocket to go sell some volatility and maybe leg into that put spread at that time.
FinWest, by the way, point out, really liked your contributions on options action. So I kind of missed that show. What we should do is we should bring back our own variant of it. That's what I think. I mean, here's the interesting thing. We could actually make it pretty tight. This is speaking extemporaneously here, but, you and I are friends. I don't know how often you speak to Scott or Jim or any of the other folks, especially those of us that were on the options side more than, I still talk to Carter. I was actually just talking to Carter earlier today. He's in Rhode Island as it happens. But, we only had about 20 minutes of talk time on that show.
Right.
When you put in the ads and the teases and stuff like that. What would it take to bring something like that back, where we gave 3 trade ideas and just said, here's what we're thinking this week?
Yeah.
Maybe we should bring that back. I don't think we can call it options action. I think we're going to find ourselves in some hot water if we did that. But action in the options market. We'll make something up.
Yeah. Write in if anybody's got any ideas on what we should call that show. Once we get a good idea, we'll put it into motion.
Yes. Alex B says a great idea, and then FinWest said, I'd love to have such a show. And then somebody else says, makes sense. Thanks for the conversation. Let me scan through this because we've chewed up a full hour here and see what else we have here. Does your Bloomberg have a Trump tariff winners list too? Actually, it does not. I'm going to pull that up again, the tariff losers list. Just so that people can, if you want to screen grab this thing, I'm just going to list them off, but there's not that many. Most of these are companies that do a lot of importing of the stuff that they sell in the U.S., not surprisingly. So Nike, a lot of their stuff is made overseas. Gap, a lot of their stuff is made overseas. In fact, actually, I think most of what we buy these days is made overseas. Brian, is there anything what do you buy that's manufactured in the United States anymore? Oh, your car probably, right?
Yeah, I do.
You drive a Tesla.
Yeah, I drive a Tesla. So, yeah.
Yeah, so this is, the top one here is Wayfair. That's not surprising. Everything Wayfair sells is probably, let me see here. I'm going to go like this. Why 3M. So 3M, American Eagle Outfitters. So names that look like they're heavily affected on this list. Why would Harley Davidson? Oh, probably because they're imagining also reciprocal tariffs and a trade war in here, I imagine. So Harley Davidson's on this list, and Harley makes stuff here, but I'm guessing that they're probably thinking that that's going to jack up the price of their stuff overseas. I don't think that's true. So this is interesting. I'll ask you your opinion on this. What Trump talked about in his speech last night was reciprocal tariffs. And all that basically means is whatever another country charges us, we will charge them. Number one, I'll ask you, do you think that's reasonable? And number two, what do you think the impact of that's really going to be? What do you think?
Yeah, well, see, okay, so here's my theory on just tariffs in general, right? Is that, everybody that wants to hate Trump or hate the idea of Trump tariffs will poo-poo the idea and say inflation is coming back. This is going to cause prices to go up. Companies aren't going to make money. When the reality is that's not all the case, right? Is what ends up happening is there's some sort of level of exchange, right? Where we've seen it already, the peso selling off in value versus the dollar upon tariffs. So what does that do? That basically the US companies that are importing can now get the goods for cheaper. So even though there's a tariff, the net effect on those companies, if the currencies were to move far enough, would have no impact on companies here in the US. Now that would affect the manufacturing company in Mexico because they're now taking in less dollars for what they were producing, but not necessarily the seller of those goods to the American public here in the US. So I don't think all of it is as negative as people point out, because I think there's going to be this currency shift that occurs, right? If you're looking for trade ideas, I would almost be long the dollar against some of these other places in anticipation. Now, our interest rates could go down because people could be worried that our economy is going to stagnate and rates come down, and then obviously the dollar doesn't strengthen as much as it should. But I do think that's one play, trade against that. And I don't necessarily think these companies will be as negatively impacted as people are predicting.
So it's interesting you mentioned that after the election, the dollar rallied really strongly up until the inauguration. And since that time, it's given back most of its gains. We're almost back to the pre-election levels. I was actually looking at this before we started today because I was wondering at that exact issue. I'll give folks some examples, and here are some things to think about. Honda just announced that they are going to manufacture the next car in Indiana that they had previously anticipated manufacturing in Mexico. If we manufacture in the States and those vehicles are ultimately sold here or exported elsewhere, that's dollar bullish, right? In the same way that one of the things that has prevented this really from happening in U.S. trade historically is that we are a reserve currency. And that reserve currency status has permitted us the luxury of being able to maintain trade imbalances with our trading partners seemingly without end. I mean, in theory, this has got to end somehow, but it hasn't done. And so if we ratchet up our manufacturing activity, that should be bullish for the dollar, right?
Yeah, I would think so. I think it's, you mentioned that the dollar's pulled back to the pre-election levels, maybe a little bit higher. I mean, I would be probably a buyer. You can use the ETF UUP to echo that sentiment. I might look to add that to a portfolio of things and hold things in terms of dollars. At least with things that are consumer discretionary names. If I've got a basket, let's say, $10,000 worth of stocks and 1,000 of it is consumer discretionary type names, I might hedge that by buying $1,000 worth of dollar.
Yeah, it's interesting because one of the things that I haven't been seeing is the implied volatility of, like, let's say 3-month options in UUP. Despite this big round trip, they haven't gone up. Vol is actually in UUP I've got this up on the screen. Maybe you can see it. 3-month implied volatility on UUP has basically just continued to come back in. It's almost back to the pre-election levels. So, it's I think back, looks like it's, I'm going to draw a line here. I'm going to put a 1 year in here. This is, by the way, currencies, everybody, are really low vol, right? So they make stock indices look wildly volatile. But I have a line here, and we can see that we're probably like mid-2024 up towards the upper end of that range. But what would be the option structure you would be inclined to use on something like UUP here? Just buying upside calls or call spreads? What's on?
I would say just buying a call, really. I mean, you mentioned the implied vol is pretty low. And I think if there's some sort of huge market shakeout, especially, it'll be easy for the dollar to rally, given these like tariff conditions. And so I'd probably want to own a call right now and then maybe look to trade around it if we get some market movement. And if it heads lower, if the dollar weakens, I would sell a put and turn it into a risk reversal.
Yeah. So we have used up about an hour and 15 minutes of everybody's time, and I could go on talking to Brian easily for an hour, but I'm sure the people that are driving the machines in the background, and apparently we've had some technical problems. I've been told my camera is actually not even focusing on me, which is probably good news for all of you who are watching. Focus on the TV and anything with this ugly mug. But I really want to say, first of all, thanks very much for showing up today and doing this. I like having these kind of casual market conversations and sort of seeing where it leads. I hope you'll come back and join us. And if you're available, you're welcome at any time. We could do this weekly if you'd like. And maybe we can frame up something that's a little more options action-esque, like Max used to have it. Risk less, make more, have like 3 trade ideas, and then just, shoot the... You know what?
Yeah, that would be fun. That would be fun to do. I'd look forward to doing that. And the viewers writing in, we'll wait for you to come up with a name for that little caveat of the show part.
Yeah. Submit your suggestions, and we're gonna. You know what we're gonna end up with? It's gonna be like that Australian boat, Bodie McBoatface. I don't know if everybody remembers that, but they were trying to come up with a name for some new scientific research vessel, and I think it was in Australia, and they the number one name that came back was Bodie McBoatface.
Hey, if that's what people want, that's what we'll give them, right?
Yeah, Bodie McBoatface options. Okay. All right, everybody. Like, subscribe, hit the notification bell. Equity Armor Investments CIO, Brian Stutland, everybody. For anybody who's interested, he runs separately managed accounts. He's got a couple mutual funds. A lot of interesting stuff going on over there. Thank you, Brian, and thank all the rest of you for watching. I'll see you next time.
All right. Thanks, Mike.